Stop refreshing your portfolio, close your trading apps, cancel whatever you had planned for the next 20 minutes, because what I am about to show you is not market analysis, it is not technical speculation, and it is not some guru's prediction. It is documented evidence, it is mathematical proof, it is the smoking gun that proves the entire global silver pricing system has catastrophically failed. For years, we have warned that paper markets were disconnected from physical reality. We have documented the vault drains. We have tracked the industrial demand explosion. We have shown you that Western paper prices bore no relationship to Eastern physical scarcity. We have said that eventually the two markets would split apart so violently that the world would be forced to choose which price is real. But until Wednesday, January 14th, 2026, that was just theory. That was just the logical projection. Well, stop theorizing, stop projecting, because that day has arrived. The markets have split. The choice has been forced. Ladies and gentlemen, this is your emergency silver market briefing. While you were checking email, while you were scrolling through social media feeds, while you were living your normal Wednesday morning, something catastrophic occurred in the architecture of global commodity markets. Something that financial journalists cannot explain with their typical narratives about technical breakouts or retail enthusiasm. The New York silver market and the Shanghai silver market, which are supposed to price the exact same physical ounce of metal, have completely divorced from each other. They are no longer connected. They are no longer correlated. They now exist in two separate realities. Right now, at this exact moment, COMEX silver in New York is trading at $91.67 per ounce. That represents a new all-time high for the Western market. Congratulations. Pop the champagne. Except simultaneously, on the other side of the planet, the Shanghai Futures Exchange is settling physical silver contracts at $104.55 per ounce. Let that mathematical impossibility sink in. $104 in Shanghai, $91 in New York, a $13 gap, a $13 arbitrage opportunity sitting in plain sight for anyone with the capital and infrastructure to exploit it. That gap is not narrowing, it is not stabilizing, it is expanding. The gravitational force that should pull these prices together has failed. In this emergency transmission, we are going to dissect exactly why this spread exists. We are going to examine why the United States Mint suspended all silver sales on the same day this gap exploded. We are going to reveal the vault drain that saw 2 million ounces vanish from depositories in 24 hours. And we are going to explain why the largest bullion banks on Earth, the very entities that suppressed silver for decades, have now capitulated and flipped their positions to long. The arbitrage bridge has collapsed, the physical metal has disappeared, and the global pricing authority has permanently transferred from west to east. This is the chronicle of the market bifurcation. This is the day the paper-silver system died. To understand the magnitude of what occurred on January 14th, you must first understand what should happen in a functioning global market. Markets operate on a principle so fundamental that economists treat it as a law of nature. It is called the law of one price. This law states that identical goods must trade for identical prices in integrated markets. If corn is $5 per bushel in Chicago and $7 per bushel in Tokyo, traders will immediately buy corn in Chicago and ship it to Tokyo, capturing the $2 spread. This buying into Chicago drives the price up. The selling in Tokyo drives the price down. The spread closes. Equilibrium is restored. This mechanism, called arbitrage, is the invisible hand that keeps global markets coherent. It is the plumbing. It is the connective tissue. Without arbitrage, you do not have a global market. You have isolated pricing islands with no relationship to each other. On Wednesday, January 14th, 2026, that plumbing exploded. The Shanghai premium was not $2, it was not $5, it was $13 per ounce. To contextualize that magnitude, imagine gold trading for $4,000 in New York and $5,200 in Shanghai simultaneously. Imagine crude oil quoted at $70 per barrel in Houston and $91 per barrel in Singapore at the same moment. These scenarios would trigger immediate congressional hearings. They would dominate financial media for weeks. They would be treated as evidence of market manipulation or systemic failure. Yet in silver, this exact dislocation occurred, and the mainstream financial press barely noticed. Why? Because acknowledging this gap forces an admission they cannot make. It forces them to admit that the paper price, the COMEX price, the New York price that has governed global silver for 50 years, is fiction. It is a lie maintained by leverage and derivatives, and the truth, the physical truth, is being revealed in Shanghai at $104 per ounce. So the immediate question becomes obvious. If there is a guaranteed $13 profit available for every single ounce of silver moved from New York to Shanghai, why are traders not executing this arbitrage? Why is the gap not closing? The answer is brutally simple. There is no physical silver in New York to buy. The vaults are empty. The metal is gone. You cannot arbitrage what does not exist. When the bridge connecting two islands collapses into the ocean, it does not matter how profitable it would be to cross that bridge. The bridge is gone. The arbitrage is dead. And the proof, the undeniable physical proof, is sitting in government data and vault statistics. Let us examine the evidence. Evidence point number 1. The United States Mint, the official manufacturing arm of the United States Treasury, the sovereign entity responsible for producing American silver eagle coins, suspended all sales of silver products on January 14th. This was not a temporary website glitch. This was not scheduled maintenance. This was an indefinite halt to operations. Why would the Mint stop selling its most popular product during a massive price rally when demand is exploding? The official explanation is that they cannot source silver blanks, the raw planchets needed to strike coins, at the current market price. Let me translate that bureaucratic language into plain English. The United States government attempted to buy silver in the wholesale market at $91 per ounce. Their suppliers refused. Those suppliers can sell that same silver to buyers in Shanghai for $104. Why would they accept 91 from Washington when Shanghai is offering 104? They would not. They did not. The United States Mint was directly outbid for physical silver by the Eastern physical market. Think about the implications. The sovereign issuer of the world's reserve currency cannot procure a strategic industrial metal at the quoted paper price. That is not a supply chain hiccup. That is a currency crisis. That is tangible evidence that dollars are being devalued in real time against hard assets. When your own mint admits it cannot buy metal to make coins, it is confessing that the paper price is divorced from replacement cost reality. That confession validates everything we have been saying for years. The COMEX price is not real. It is a mathematical construct maintained by paper leverage. The real price is what industrial users pay for actual metal. And in Shanghai, that price is $104. Evidence point number 2. While the Mint publicly surrendered, private vaults were being quietly drained. On Wednesday, January 14th, over 1.3 million ounces of physical silver were withdrawn from J.P. Morgan Chase depositories. Across the entire COMEX system, including major withdrawals from Brinks and other custodians, nearly 2 million ounces vanished from reported inventories in a single 24-hour period. 2 million ounces. That is not retail investors buying a few tubes of coins. That is institutional capital. That is sovereign wealth funds. That is multinational corporations. These entities are executing what can only be described as a bank run on physical metal. They are taking possession. They are eliminating counterparty risk. They are following the oldest rule in precious metals. If you do not hold it, you do not own it. Why are they doing this now? Because they have done the same mathematics you are doing right now. They observe Shanghai paying 104 while New York quotes 91. They recognize that the paper price is artificial. They understand that when the system breaks, when confidence evaporates, paper claims are worthless. Only physical possession matters. So they are moving metal out of the shared pool, out of the fractional reserve system, into private vaults where it cannot be rehypothecated or leveraged or lent multiple times. This is not normal market activity. This is emergency preparedness. This is crisis positioning. And the scale, 2 million ounces in one day, indicates that the smart money, the connected money, the money with access to order flow data and vault reports, believes the system is on the verge of catastrophic failure. Evidence point number 3. Demand for physical delivery against COMEX futures contracts has exploded to levels never before recorded. In January 2026, approximately 6,800 contracts are standing for delivery. Each contract represents 5,000 ounces. That totals 34 million ounces of silver being demanded for immediate physical settlement. Compare that to January 2025, when delivery demand stood at roughly 2,000 contracts or 11 million ounces. Compare it to January 2024, when only 1,600 contracts or 8 million ounces stood for delivery. The demand has tripled in 1 year. It has more than quadrupled in 2 years. Traders are no longer willing to accept cash settlement. They are no longer willing to roll their contracts forward into future months. They want the metal. They want it now. They want physical bars and allocated storage. This behavior signals a systemic loss of faith in paper promises. When COMEX was designed, it was intended to be a price discovery mechanism and a hedging venue for industrial users. Physical delivery was meant to be the exception, not the norm. Most contracts were supposed to be closed with cash, but when 34 million ounces are demanded in a single month, when traders refuse cash and insist on metal, the exchange faces an existential threat. Because the dirty secret of commodity exchanges is that they operate on fractional reserves. There are far more paper claims than there is physical metal backing those claims. It works fine as long as everyone agrees to play the game, as long as everyone accepts cash settlement. But when the music stops, when everyone demands their metal simultaneously, the system collapses. We are watching that collapse in real time. The January delivery numbers are a warning siren. They are telling you that confidence in paper settlement is evaporating. Now consider the short seller annihilation that is unfolding behind closed doors. Picture the situation from the perspective of a major bullion bank. For decades, your trading desk has made consistent profits by selling short silver futures. You flood the market with paper supply whenever prices rally. You collect premiums. You profit from volatility. You manage risk with sophisticated hedging. Your models assume that physical delivery will remain a small percentage of open interest. Your models assume that arbitrage will keep New York and Shanghai prices aligned. Your models assume that Western vaults contain enough metal to satisfy any delivery surge. All three of those assumptions have now failed simultaneously. You are short silver at an average price of perhaps $70 per ounce. New York had just traded to 91. Shanghai is at 104. Your losses are catastrophic. Your risk management systems are flashing red. Your counterparty exposure is exploding. Normally, you would simply buy contracts to cover your short position, close out the trade, take the loss, move on. Except you cannot, because your shorts are not just paper obligations. Some of your clients, some of the entities on the other side of your trades, are demanding physical delivery. They are standing for delivery. They want bars, and you do not have bars. The vaults are empty. You cannot cover a physical obligation with a paper purchase. You need actual metal, and there is no actual metal available at $91. The only metal available is in Shanghai at 104, so you face an impossible choice. You can attempt to buy metal in Shanghai, ship it to New York, and deliver against your short obligations. But China's new export licensing system makes that almost impossible. Metal flows into China easily. Metal does not flow out. The one-way valve has been installed. The repatriation door has been closed. Or you can default. You can admit you cannot deliver. You can trigger a force majeure event and accept the legal and reputational consequences of failing to honor your contracts. Or there is a third option. You flip, you capitulate, you cover your shorts at devastating losses, and you go long. You switch sides, you stop fighting the rally, and you start riding it. And that, according to emerging evidence and market behavior, is exactly what the largest bullion banks are doing right now. This is the bank capitulation scenario. For decades, these institutions were the suppressors, the entities that capped every rally, the invisible hand that kept silver contained. Now they are becoming the propellers. They are using their infinite liquidity not to sell into strength, but to buy into strength. They are abandoning their multi-decade short positions and aligning with the physical reality of $104 silver in Shanghai. This flip is seismic. It removes the single largest obstacle that has prevented silver from reaching fair value. When the banks were short, every rally was met with a wall of selling. Now, as they go long, their buying becomes rocket fuel. It becomes a tailwind instead of a headwind. The evidence for this capitulation is circumstantial but compelling. On Tuesday, January 13th, the CME Group raised margin requirements for silver futures by 15%. This is a classic regulatory tool designed to cool speculative fervor, shake out leveraged longs, and provide breathing room for struggling shorts. In normal markets, a margin hike creates immediate selling pressure. Traders who cannot meet the new capital requirements are forced to liquidate positions. Prices decline, the rally stalls, shorts cover at lower prices, and the establishment wins. Except that is not what happened. After a brief dip toward $85, the market absorbed every ounce of selling and exploded higher. New York ripped from 85 to 91 in hours. Shanghai went from 93 to 104. The physical demand overwhelmed the paper manipulation. The margin hike failed. It failed because the buyers were not speculative retail traders who could be shaken out. The buyers were industrial corporations that need metal to keep factories running. The buyers were sovereign entities accumulating strategic reserves. The buyers were the banks themselves, covering shorts and building longs. When your buyer base is driven by inelastic need rather than speculative greed, margin hikes are irrelevant. The rally continues regardless. So the suppression mechanism has failed. The arbitrage bridge has collapsed. The government has surrendered. The vaults are being drained, but silver is not moving in isolation. There is another signal flashing red on the global financial dashboard. A signal that reveals this, transcends silver supply dynamics. A signal that indicates systemic instability in the broader monetary architecture. That signal is gold. We must shift our focus momentarily from silver to examine the larger battlefield. Because gold's performance on January 14th, while less dramatic in percentage terms, carries infinitely greater implications for the global system. Silver is volatile. 3% moves happen. We expect it. We trade around it. But gold is the bedrock. Gold is the $15 trillion asset owned by every central bank on Earth. Gold is the reserve asset of last resort. It moves slowly, predictably, boringly, until it does not. Observe the gold price right now. COMEX gold is trading at $4,644 per ounce. That is a new all-time high. That is up over $40 from the previous session. A $40 move in gold in a single session is a seismic event. It is a black swan. To put that in perspective, a 1% gold move is equivalent to the Dow Jones Industrial Average moving 1,500 points in a day. It does not happen during routine economic data releases. It does not happen because of earnings reports. It happens during the invasion of Ukraine, during the collapse of Silicon Valley Bank, during Lehman Brothers, during the 2008 financial crisis. When gold moves with this velocity, when it surges by 1% or more intraday, the market is broadcasting a distress signal. It is telling you that something fundamental within the financial system has broken. Intelligent capital, central banks, sovereign wealth managers, family offices with centuries of accumulated wisdom, they are evacuating dollar exposure. They are fleeing bond markets. They are flooding into the only asset with zero counterparty risk. This gold surge validates silver's ascent. It confirms that we are not witnessing isolated speculation in silver. We are observing a comprehensive repricing of monetary metals against depreciating fiat currency. Silver is drafting in gold's slipstream. And when the king sprints, the prince accelerates exponentially. This is the beta relationship. In financial terminology, beta measures an asset's volatility relative to its benchmark. Silver historically operates as leveraged gold. It carries a beta coefficient of 2 to 3 times gold's movement. If gold advances 1%, silver typically climbs 2 to 3%. The mathematics are remarkably consistent across decades. Today, gold moved approximately 1% at its intraday peak. Silver climbed nearly 3%. The correlation is perfect. This is textbook precious metals bull market behavior. If silver had gained 8% while gold remained flat or declined, I would urge extreme caution. That would signal speculative mania detached from fundamentals. But because gold is confirming with a historic breakout, silver's rally is structurally validated. The world is repricing tangible assets against paper promises. Gold is doing the structural heavy lifting. Silver is capturing the overflow. The overflow concept is critical. When institutional capital flees dollars, when it evacuates bonds and equities seeking safety, the first destination is always gold. But gold has capacity constraints. There are only so many bars available at any given price. There are only so many contracts that can be absorbed before liquidity evaporates and prices gap violently upward. What happens to the capital that cannot find entry into gold? It cascades into silver. And because silver's market capitalization is perhaps 1/10 the size of gold, that spillover creates tidal wave price effects. $1 billion flowing into gold barely registers. $1 billion flowing into silver can move the price 5 to 10% in hours. We are witnessing that overflow right now. Gold hit all-time highs. The safe haven trade is fully engaged. The excess capital is pouring into silver. And silver, with its tiny market size relative to gold, is amplifying the move exponentially. We must ask the critical question, why today? Why Wednesday, January 14th? What triggered this simultaneous surge in safe haven demand? We know about ongoing geopolitical tensions, Venezuela, Middle East conflicts, trade disputes. But typically, geopolitical headlines spike precious metals briefly before profit-taking pulls prices back down. This rally did not fade. It accelerated through the session. It held. It built momentum. This behavior suggests the market is detecting something deeper than geopolitical noise. It suggests financial contagion risk. It suggests problems within banking infrastructure or sovereign debt markets that have not yet been disclosed publicly. History teaches this pattern. In September 2008, gold spiked before Lehman Brothers collapsed. In March 2023, gold surged before Silicon Valley Bank failed. The gold market has insider participants. Central banks trade gold. Sovereign funds trade gold. They possess information that retail investors do not access. When gold moves violently without obvious catalysts, it indicates insider flow. Someone somewhere knows something that is not yet public. Perhaps a major bank is facing liquidity crisis. Perhaps a sovereign entity is preparing to dump treasury holdings. Perhaps geopolitical escalation is intensifying beyond current public knowledge. The specific headline remains unknown, but the price action is the news. Price is revealing that safety demand has suddenly intensified dramatically, and silver serves as the accessible safe haven for ordinary people. When gold approaches $4,600 per ounce, it becomes prohibitively expensive for average retail investors. A single 1-ounce gold coin costs more than most people earn in a month. At $91, silver remains affordable. A silver eagle costs under $100. This accessibility creates substitution demand. As gold prices itself out of reach for ordinary citizens, as it becomes a luxury reserved for institutions and ultra-wealthy individuals, retail capital pivots to silver. This dynamic propels silver higher, even as gold's own rally continues. The accessible alternative to expensive gold becomes silver, and that substitution demand is only beginning. The public has not yet awakened to this story, but they will. And when they do, when your dentist asks how to buy silver, when your Uber driver mentions he just purchased coins, We will transition from the current institutional accumulation phase into full public mania. We are not there yet. We have not even approached that psychological extreme, which means substantially more upside remains ahead. Now, let us examine the gold-silver ratio, one of the most important gauges in precious metals analysis. This ratio measures how many ounces of silver are required to purchase 1 ounce of gold. Throughout human monetary history, from ancient Rome through the Renaissance to the United States Constitution, this ratio naturally hovered near 15 to 1. 15 ounces of silver bought 1 ounce of gold. That reflected the relative geological scarcity of the two metals. In the modern era of paper market manipulation, that ratio exploded to absurd extremes. It reached 80 to 1. It touched 100 to 1 at certain crisis moments. Silver was artificially suppressed while gold was allowed to rise. The ratio became grotesquely distorted. But now it is compressing. It is reverting toward historical norms. With gold at 4,644 and silver at 91, the current ratio sits at approximately 51 to 1. We have compressed from highs near 100 down to 51. That is substantial progress, but we remain nowhere near the historical 15 to 1 equilibrium. If the ratio were to revert fully to 15 to 1, and if gold merely holds current levels without advancing further, silver would need to trade at $308 per ounce. $308. Let that calculation settle. We are talking about a potential more than tripling from current levels just to reach historical parity with gold. This is not speculative fantasy. This is mathematical reversion to multi-thousand-year norms, and it explains why sophisticated algorithms and institutional traders continue accumulating silver aggressively. They are executing ratio arbitrage. They are selling expensive gold and buying cheap silver to compress the spread and capture the mean reversion profit. As long as gold maintains strength above $4,000, as long as gold holds elevated levels, silver's mathematical floor rises automatically with it. Gold provides the fortress. Silver is the spear tip of the precious metals advance. But we must return to the core crisis, the Shanghai premium, the market bifurcation, because that is the immediate catalyst forcing this repricing. The $13 gap between New York and Shanghai is not theoretical. It is not academic. It is creating panic in corporate boardrooms right now. If you operate a solar panel manufacturing facility in Jiangsu province and your raw material cost just jumped from 91 to 104 in a single session, you are experiencing genuine operational terror. You're about to engage in emergency procurement to secure inventory before tomorrow brings another surge. This is where we examine the industrial demand component, the inelastic buying that is setting a hard floor under physical prices regardless of what paper markets attempt. Industrial demand for silver is fundamentally different from investment demand. Investment demand is elastic. If silver becomes too expensive, investors can wait. They can delay purchases. They can shift capital elsewhere. But industrial demand is inelastic. Manufacturers cannot wait. A solar panel requires silver paste for conductivity. An electric vehicle requires silver for its complex electrical systems. A smartphone requires silver for touchscreen functionality and circuitry. If you are Samsung and you need 1 ounce of silver to complete a phone that sells for $1,000, you will pay $200 for that ounce before you will halt production and forfeit the entire $1,000 sale. The silver represents perhaps 5 to 10% of your total cost structure. Losing the entire revenue stream to save 5% on inputs is insane. So manufacturers pay. They pay whatever the market demands. And right now, in Shanghai, the market is demanding $104. This creates counterintuitive buying behavior. When prices spike dramatically in a compressed time frame, the procurement officer does not conclude that silver has become too expensive, and therefore he should reduce consumption. His thought process is the opposite. He thinks a shortage is developing, a crisis is emerging. I must purchase substantially more immediately, right now, before supplies vanish entirely and my production line shuts down. So rising prices actually trigger accelerated buying, not reduced buying. We are receiving reports from industry contacts that solar manufacturers and electronics producers have doubled or tripled their normal order quantities today. They are abandoning just-in-time delivery models and pivoting aggressively to just-in-case hoarding strategies. They are building massive inventory buffers to protect against future shortages. This behavior transforms a simple price spike into a self-reinforcing spiral. Higher prices signal scarcity. Scarcity triggers hoarding. Hoarding removes supply from the market. Reduced supply drives prices even higher, which signals more scarcity, which triggers more hoarding. The feedback loop becomes exponential. We saw this pattern in 2021 with semiconductor chips. We saw it with lumber. We are watching it unfold now in silver. This is what economists classify as an inventory supercycle. And once it begins, once industrial buyers shift from just-in-time to just-in-case psychology, it becomes nearly impossible to reverse. The hoarding continues until either prices reach levels that genuinely force demand destruction, or until new supply floods the market and rebuilds confidence. Neither scenario appears imminent. Prices would need to reach levels that make silver substitution viable in industrial applications. But silver has unique conductive and reflective properties that make substitution difficult or impossible in many uses. And new supply, new mine production cannot respond quickly. It takes years to bring new mines online. The supply response is geologically constrained, which means the industrial hoarding behavior will likely persist and intensify for months or quarters ahead. So we have systemic market failure. We have government capitulation. We have vault drains. We have bank position flips. We have gold-confirming systemic stress. We have inelastic industrial panic buying. And now the final domino is about to fall. The public is waking up. For years, silver quietly climbed from $20 to $50 to $70 to $90. The mainstream financial media maintained strategic silence. Acknowledging a monetary metals rise is a tacit admission that fiat currencies are failing, so they ignored it. They pretended it was not happening. But when silver hits all-time highs in New York and smashes through $100 in Shanghai, the story becomes too large to suppress. It forces itself onto screens. It dominates tickers, it generates headlines, and headlines generate retail panic, fear of missing out. The psychological trigger that transforms calm markets into manias. That media pivot is beginning right now. And when it fully engages, when your relatives ask you about silver at family dinners, when financial advisors who mocked precious metals for decades suddenly recommend allocation, we will enter the terminal blow-off phase. The tragedy is that this wave of retail demand, this flood of panic money seeking to protect savings, will crash into a market with virtually zero available inventory. The mint is closed. Private dealers are sold out. Local coin shops have empty display cases. And the premiums, the amount charged over spot price for physical delivery, are exploding to unprecedented levels. In India, the world's largest silver consumer, local prices have reached $132 per ounce. $132. That is a 45% premium over the New York paper price of $91. The physical market is completely detached from the screen price. You cannot acquire actual metal anywhere near the quoted futures price. This disconnect is the final proof. The paper price is fiction. The physical price is truth. And the truth is being revealed in Shanghai, in Mumbai, in coin shops across America where premiums are approaching 50 to 100% over spot. This creates what we call a liquidity vacuum. Massive new demand colliding with non-existent supply. The outcome is a bidding war. When the public finally decides to buy and discovers nothing is available at quoted prices, they panic further. They bid higher. They agree to larger premiums. They compete for the scraps of inventory remaining. This feedback loop drives premiums to levels that seem irrational until you understand the psychology. People are not buying silver to flip for profit next week. They are buying to protect against currency collapse. They are buying to preserve purchasing power across decades. From that perspective, paying $130 for metal quoted at 91 is rational if you believe the 91 quote is artificial and temporary. You're paying for certainty. You're paying for possession. You're paying to exit a system you no longer trust. So where does this end? When does equilibrium return? The answer is that equilibrium returns when New York prices rise to meet Shanghai prices, when Western paper markets capitulate to Eastern physical reality, when COMEX silver trades at 104 to match Shanghai, or when Shanghai rises further to 120 and New York follows. The direction is clear. The paper price must rise to meet the physical price, not the other way around. Physical scarcity sets the floor. Paper leverage cannot suppress physical reality indefinitely. The gap will close through New York rising, not through Shanghai falling. Because Shanghai buyers are industrial end users who must have metal. They set the price by their willingness to pay whatever is necessary. New York traders are playing with contracts and leverage. They will eventually surrender to the physical market's authority. That surrender is happening right now. The $13 gap is narrowing, not because Shanghai is coming down, but because New York is being dragged upward by the gravitational force of physical demand. This is the great disconnect. This is the market bifurcation. This is the day the paper system died and the physical system was born. Wednesday, January 14th, 2026, will be remembered as the inflection point, the moment when 50 years of Western price control ended and Eastern physical demand established new pricing authority. If this emergency breakdown helped you understand what is occurring in real time, hit that like button and let me know you're paying attention. Subscribe if you have not already, because we will track every development as this historic wealth transfer unfolds. This is the Asian Guy, documenting the greatest monetary reset in modern history. And I will see you in the next breakdown. The bifurcation has only just begun.